Right. Well, modern portfolio theory, it's been a few decades, Tom. It's been a few decades since this thing's been updated. I think it's overdue. What do you think? It's ironic, and I'm gonna kind of skip over the backstory. Well, actually, no. Let's get into it. John, hit us on the intro slide. So let's not jump the shark here too quickly. Okay. So modern portfolio theory is one of the core pillars of academic finance and has been so for many, many decades, which is ironic in and of itself if you just kind of read that sentence. With its claim to fame being a mathematical construction of the optimal weightings between risky assets to achieve the best balance of risk and return. But modern, quote unquote, modern portfolio theory does not include any type of derivatives. So if it did, could it be improved? So gentlemen, my question for you here this morning is, do you think you can even have something in 2025 titled Modern Portfolio Theory that does not include derivatives?
No.
I wouldn't say. I would say no. Also, I had to think about that though.
I mean, I completely agree. I completely agree with you. I mean, in the world that we live in now, and especially, I mean, the retail trader, retail investor access that we have to the platforms and the technology and the products, it's like, man, I don't know how you can still have something called modern portfolio theory that essentially hasn't changed for many, many, many decades. And that's exactly what we're going to talk about here this morning. Is if we did begin to include something like derivative exposure into our portfolios, how would modern portfolio theory change? Now, I know, and I mention this from time to time when I think it's applicable, there are a lot of graduate students, doctoral students that watch our content, that have reached out to me about various things over the years. If you are a graduate student right now, or you are a doctoral student right now, and you are trying to think of a dissertation or thesis topic, this is something to put in the old back of the noggin that could be an option for you. So something like this that could kind of update what we've been using for many, many decades. Just a shout out there to our academic students that might be out there. All right. So John, hit us here on the next slide. So here's kind of the coup de grace. Here's kind of the claim to fame. Here's kind of like the Jared Goff, right, of academic finance. The capital market line. So in modern portfolio theory, what you're essentially trying to figure out is what is the optimal ratio between two risky assets. So you have a portfolio that's two risky assets. You have risky asset A and risky asset B, and you're trying to figure out, what is the optimal combination of these two assets in my portfolio? Well, here is what modern portfolio theory essentially shows us, and I'm skipping over a bunch of steps. I'm skipping over risk-free rates. I'm skipping over betas, tangential lines. I mean, all that stuff is here, but I kind of want to get to the meat and potatoes. If you look at the portfolio return on the y-axis and the portfolio risk on the x-axis, what you see in a portfolio construction is kind of this funny looking curve, like this backward bending curve that kind of shows you what the weightings between A and B would look like. Well, here are some important points and observations about this curve. Again, this is standard modern portfolio theory that, Tom, I think this was developed in the 50s. In the 1950s, Tom, it's been 70 years. 70 years, this thing hasn't changed. What do you think about that?
For somebody who likes a lot of change, I think is his point.
I'm okay with change, yes.
But it hasn't changed in 70 years.
I'm not a purist.
That's so surprising to me. You're so, I mean, for being as old as you are, the fact that you're so open to change is, man, that's really a testament to you. I got to give it to you.
That'll be the only thing we give him.
Portfolio return, portfolio risk. Okay, 2 points. Number one, in portfolio theory, you always have what is referred to as the minimum variance portfolio. So there are a lot of conservative investors out there, a lot of conservative traders out there that they kind of want to know, all right, where is the point where I can achieve a modest level of return but really take my risk down to the lowest possible level? Like, what is that point? Where does that exist? Well, that, of course, is going to be on this curve. You see that right there as the minimum variance portfolio. Then the green segment, the highlighted green segment that is above that portfolio, these are going to be all the combinations between asset A and asset B that offer you an optimal balance between risk and return. Because if you look at that graph, you always want to move, if you could, you always want to move to the upper left. You always want to move to the northwest of that graph. You always want to go higher on the y-axis to improve your return, and you want to go lower on the x-axis, so to the left, to reduce your risk. But because of the various standard deviations and the various, risk parameters of the two assets, there's only so much you can do. You can't just peg your portfolio with all return and no risk. That's not possible, of course. But when you think about the green line that's on this curve, this is where you want to live in modern portfolio theory. That is referred to as the efficient frontier, because all of those portfolios are efficient. None of them are dominated from a risk return standpoint. Any dot on that green line is going to give you the best possible breakdown and combination of risk and return in your portfolio. And you decide how much return you want per unit of risk. Very similar to how we might look at like a delta theta ratio, as an active trader. Very similar idea. Okay. So this is old modern portfolio theory. Okay. So John, hit us on the next slide. This is where it starts to get very, very interesting. If we add options to the mix, we can kind of create for ourselves an option frontier. So there's two things that we can do. We're going to see the first one on this slide. We're going to see the second one on the next slide. When it comes to, first and foremost, reducing the risk of your portfolio, and I know you guys are both going to agree with me. Sometimes on these Monday mornings, we don't agree. Sometimes on these Monday mornings,
it's hit or miss sometimes.
It's more miss than hit, but yes, it's certainly both. Yes, correct. I think we're all going to be in agreement. I think we're all going to be on the same page. This is something that I think gets overlooked so much in the derivative space. When you add derivative exposure to your portfolio, like short options, for example, it is so easy and simple to reduce the risk of your portfolio, to reduce the overall portfolio risk that you're exposed to. And I think this is something that a lot of people miss. Would you guys agree with that as just a general statement?
Yeah.
I mean, you can't now, right? I mean, you guys just answered an email a couple days ago. I was watching Confirm and Send. I saw the email that came in. The guy had I think he had like a 12 or 15% return for the year, but his risk was significantly less. And he was trying to ask you guys if that was a success or not. And what did you guys say?
Yeah, for sure. I mean, it depends on how much risk you're taking, but yeah, for sure.
Because when you think about what are we trying to achieve as, active traders? We're trying to achieve higher return and lower risk. Now, sometimes we have to choose one over the other, of course. It's very difficult to find both at the same time. But both are considered victory. Like both are considered a W, right? And so I think that's an important thing to remember. I mean, we get so fixated on returns. We get so fixated on making money. And rightfully so. I mean, that's why we're doing what we do. But if you're able to achieve similar returns at much, much less risk, then that can be, a victory in and of itself. And even if you achieve less returns, lower returns, which I think is kind of what he was emailing about, 15% relative to SPY at 25 last year or whatever, like that is an underperformance. But if you factor in the lower volatility, it may not be underperformance. It may actually be better. Right,
Sure.
Tom?
Sure.
Yes,
I'll answer for Tom.
Yeah, I mean, sure.
I mean, you say of course, but I think a lot of people skip over this step. I think it's important for us to kind of slow some things down. Like, let's control the mechanism here, and let's make sure we understand, that taking out risks is a big thing too.
I agree. You're taking little liberties with patting yourself on the back here, or at least talking about it, not yourself, you. But yeah, I agree. But this is what you're supposed to do.
I liked our answer better, just so you know. Our answer was that benchmarks can be misleading because you're not competing against a benchmark. You're competing against the amount of risk that you're taking.
Yeah, but that's what he's quantifying it here with, right?
I understand a little bit. Yeah.
Mm-hmm. Mm-hmm.
No, I mean, of course. I mean, you are absolutely benchmarking against the number of the amount of risk that you're taking. But that's kind of what I'm trying to say here this morning, at least on this slide.
Okay.
I think so many people, benchmarking to a major index. I mean, it makes some sense, at least at a base level, just kind of thinking in very simple terms. But then you have to go the next step. You have to quantify the amount of risk that you're taking. The option frontier, minimum variance portfolio, it's going to be even lower risk. Okay, John, here's on the next slide. But what if we look at an even different scenario where now you have a portfolio where because of the added derivative exposure, because of the added options, you have the opportunity for not only lower risk, but higher returns because now you have a more strategically diversified portfolio. Because now you have other ways to make money that are not just tied to the directional exposure of the overall market, where, I'm passively long, market goes up, everybody's happy, market goes down, everybody's sad. I mean, it's very simple, straightforward, and I guess that's a benefit. But it doesn't really give you a lot of strategic flexibility. With the option frontier, right? And with added derivatives to your portfolio, we all know this. We're kind of beating a dead horse, but I just think when it comes to the connection to academic finance, when it comes to the way that most traditional, investors and money managers think, even if they go as far as, go as deep into academic finance, into something like modern portfolio theory, they're going to run into some problems. They're going to run into some difficulties in kind of connecting that to the markets that we trade today and the global financial marketplace as we have it in 2025, where you have things like options, futures, options on futures, et cetera, that really, this may all look like a bunch of theoretical hand waving and whatever, but it's actually very simple to get to that dashed line today. It really is, just by adding short put exposure in place of long shares. Short strangles to get neutralized exposure, like things like that are going to allow you to minimize your risk while also potentially increasing your returns. And so this is how we update modern portfolio theory, gentlemen. You think we did an okay job?
Yeah, I think modern portfolio theory needs to be updated. I think it's time. You can own it.
After 70 years, because a moment ago you said it was fine. You probably just weren't paying attention, that's all.
No, I think modern portfolio theory is fine. I just think what he mentioned to start this off with, it needs to be updated.
So, for few theories have contributed more to portfolio analysis than modern portfolio theory, as it allows investors to conceptualize the best weightings between risky assets in their portfolios. But perhaps modern portfolio theory is due for an update, as simply adding short premium to any equity portfolio could reduce risk and increase returns